and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show. Joining us today are TS Harihar of HRBV Client Solutions, along with Vivek, Mavani and Sharmila Joshi, who are independent investment advisors. Today on Hot Money, we'll discuss some of the recent IPOs that have been wealth creators in the recent time. We ask whether any of the recent IPOs are worth investing at this point of time. The other stock that we want to talk about is Nestle. Nestle is now on a Nifty 50 stock. We asked them whether the short-term top has been made. Valuations at 60 times now, one of the most expensive FMCG companies. Apart from it, we talk about Z Entertainment, whether it still makes an investment case despite significant value erosion, because you are actually buying one of the largest media networks here. And we discuss MCX, which made an all-time high in the recent past. But before we start that, pull up to Indiabulls Housing Finance. Pretty much that will be the stock of the day. It's down almost 30% because of the prompt corrective action under which Lakshmi Vilas Bank has been put under. Probably now people believe that the merger won't go through it. Just a quick comment from our experts before we move on to the first stock. What's your sense, Hari? Indiabulls Housing Finance, does it make sense for anyone to bottom fish in this group, or what's your sense? Just stay away from it.
No, I don't see any harm in buying the stock, because what I believe is this PCA for LVB is only going to be positive as far as Indiabulls is concerned, because they are probably going to be able to bargain for a much better swap ratio in this case, as against what they were originally going to pay. So I don't think the merger is going to fall through, because there are a lot of advantages. Indiabulls gets a balance sheet, it gets a banking license, so there are a lot of advantages to Indiabulls. So I don't think the merger should fall through. Probably it should happen at a much more attractive price than what we're already seeing. So I think if you are an investor with about a one and a half year perspective, I see no harm in buying Indiabulls Housing at these prices.
You are not concerned about, because a lot of corporate governance issues have been raised in terms of some of the politicians like Subramaniam Swamy and PLs have been put. So you are fine with the corporate governance issues at Indiabulls Group?
No, I won't say there are no corporate governance issues. I think there are corporate governance issues, but that is probably as much or as little as corporate governance issues you have with most of the companies in India. So I don't think I would read that as something very unique to Indiabulls Housing. But at the current price, I think the downside risks to me look to be very limited. And let's not forget, they have a good portfolio. And if you look at the portfolio of properties they carry, the portfolio is fairly good. I don't think there is any harm. I agree there are corporate governance issues. There have been issues of funds being going in and out of the company. But if you leave all that aside, I still think at 280 the downside risk appears to be very limited.
Okay, quickly, Sharmila, your sense, if someone wants to take a bet at 280, whatever the stock price is, should they or should they just avoid?
I think completely avoid.
Okay, completely avoid.
Yeah, because I think I agree with you in the sense that the corporate governance issues are there. You cannot ignore those. And honestly, this is a market where you are able to buy, I think, less leverage, less sort of better performing names, where you can expect things to improve faster. And here there are many question marks. I think, like, what happens with Mr. Gehlot's role going ahead, because he has offered to step. So there are just too many question marks in my mind at this point in time. And this last piece of news hasn't done them any favor, either for LVB or their this EIL getting admitted. Okay. So it just opens up too many sort of grey areas. So I would just stay out.
Okay, very quickly, what's your sense?
Absolutely, completely avoid. In the sense that two things. Firstly, right from day one, I was of the opinion that the Indiabulls LVB merger will not go through. RBI will certainly not approve it, because it sets a precedent about an NBFC or housing finance company indirectly getting a banking license through the back door, and RBI has been controlling who gets banking licenses and or not. And I mean, if Indiabulls and LVB merger were to be approved, then you cannot stop an Edelweiss acquiring some other small bank, or a Tata Capital or Aditya Birla Capital each acquiring some small. There are enough small banks in South India, like City Union Bank or a Federal Bank or a whole lot of other small banks, and each one just getting indirectly a banking license. So right from day one, I was of the opinion this merger is not going through, number one. Number two, the corporate governance issues over the last several years. I mean, it's just a no-go area. You can take a risk on earnings growth, you can take a risk on valuations by buying something expensive, but in a market scenario like this, you certainly can't take a risk on corporate governance, where you don't know what kind of skeletons will tumble out of the cupboard and what all remains hidden. So it's certainly just an avoid.
Okay, that's the view that's coming in. That was stock that we had to discuss, not part of the discussion, but nevertheless down 30% certainly deserves mention. The first stock that we want to talk about is recently, if you see, in the last 1 year, there were almost 14 to 15 IPOs that came out. only 2 of them actually came out with negative returns since the time their issue price. So most of them have done well. Counters like Metropolis, India Mart, all of them have come out today. IRCTC opens. The demand, at least on what's being spoken about, appears to be rather robust. Hari, any of the recent IPOs or some of the delisted companies like like a Spencer's or something, so we can consider all of them. Anything that you find attractive in the recent what has been recently listed?
See, of all the recent listings, I think the only IPO I did find attractive, or I find attractive even now at these prices, is the REITs of Embassy, which was I think about 4 or 5 months back. I agree that the REITs IPO has done very well post listing. It's already up about 25-30%. So there are questions about the sustainability, but I still think that if you have a long-term perspective, this REITs definitely is one of the better IPOs. Other than that, I'm not looking at any of the other IPOs, but one stock I do like is IIFL Wealth, which just got demerged out of the overall IIFL holdings. And what used to happen was that it had a finance business, it had a broking business, and both the broking and finance business typically got a very low valuation, while the wealth got a higher valuation. Now that IIFL Wealth has been hived off, I think that company should be able to get a much higher valuation, which is independent of the finance business and the broking business. So IIFL Wealth is one stock. I think post demerger, I see a lot of positives.
Okay, IIFL Wealth and Embassy REITs, which has already moved up, but IIFL Wealth is the stock that's been spoken about. Sharmila, anything that you liked in the recent past to move the listings?
So not recent past, but I like IRCTC.
Okay, yeah.
So fortunately, we are talking at a time when the issue is just opened, and I think that's a great issue because all the verticals that they are in, they have like virtual monopoly. Whether it is the online ticket booking, whether it's the catering, whether it is the water. And all three have like really tremendous potential going ahead in in the sense of where they can take the business to. And I think the second factor is that the IPOs coming at a time when markets are considerably depressed, so the pricing of the IPO is really good. So that leaves a lot of upside on the table for people who get in now, which I think was missing in some of the earlier IPOs. Because if you're getting the IPO at such a high price, then what are you really leaving for retail investors? But I think in this case, you do have a lot on the table, and so I think this is definitely something that investors can look at.
Okay, so you like IRCTC. Remember, the IPO is open right now. If it will be listed at a market cap of almost 5,000 crores, so you're getting a big monopoly business at a market cap of 5,000 crores. Remember, we go to our website, we've put out an article stating what do you need to watch out for this IPO. So that is something that you need to watch out for. Vivek, anything that in the recent past that caught your eye?
Yeah, so there's another railway company by the name of RITES, RITES. It was listed last year, sometime around July, August. They've already had a one bonus issue of 1 bonus share for 4 shares. So basically, RITES is a play on upgradation and infrastructure, both on railways and including now into non-railways also. So basically, this is a technical and a consultancy company that irrespective of the outcome, right from pre-feasibility studies to project reports and even project management and monitoring, gets a small fee based income out of it. The focus of the government over the last 5 years and the subsequent 5 years also on the railway infrastructure and infrastructure in general doesn't need to be elaborated. I mean, railways itself has got a budget of something like close to 1,70,000 crores in terms of spend on upgradation and new infrastructure rollout. This is besides the metro rail projects that several cities are going to be rolling out. RITES has already done pre-feasibility studies for 15 cities metro, and about 5 have already been approved and work has started, which RITES does have a part to play. So basically this company has got a sustainable opportunity as far as India is concerned. To make it better, it also has a meaningful presence in other emerging economies like Africa, parts of Asia and Southeast Asia, where like India, similar huge amounts of money is being invested by the respective governments on upgradation and laying of the new infrastructure. In terms of order book, they have enough order book to sustain about 20% growth for the next 3 to 4 years. A company that generates free cash flows, has a debt-free balance sheet, plus has about 1,300 crores of surplus cash sitting on the balance sheet, generates return on capital and return on equity of about 17-18%, which can be sustained going forward also. Of course, with a strong balance sheet, now they are also into executing turnkey projects and they can leverage their own balance sheet, and the surplus cash potentially will be returned back to investors in form of dividends, buybacks, or whatever the case may be. Valuations at just about 12 times 1 year forward earnings, about 7 times EV by EBITDA, I think is pretty cheap.
Okay, that's the view that's coming in from some of the recently listed companies. You had counters like IRCTC, RITES, as well as IFL Wealth that you need to watch out for. The other stock we want to talk about is Nestle India. Now it came from Friday. It's part of the Nifty 50. But couple of things historically, if you see some of the recent inclusions on the Nifty, actually don't tend to do well after it. The other part is that majority of the buying that happened from the time of inclusion till the date has already gone through, and valuations at over 60 times this year, 48 times next year. It's no longer a cheap stock in a market, one of the most overvalued stocks currently. But is a temporary top made in Nestle? What should one do, or should one continue to buy this counter? What's your sense, Sharmila? Nestle?
Yes, I think that a temporary top has been made, and I think precisely for the reasons that you mentioned, that anecdotal evidence seems to suggest that once the stock comes into the indices, it tends to sort of correct or stay there because all the buying happens pre the event. Secondly, I think yes, Nestle sort of was an outlier in the FMCG segment where the numbers were good. And they've really recovered very nicely from that whole Maggie debacle, and the way they've positioned themselves and the things that they've done have really meant that their numbers were better than most of the other FMCG plays. But yes, the short point is that the valuations today are much higher than even, forget the rest of the sector. I think even the historical valuation that Nestle used to trade at. So I think a temporary top, I think, has been put. It doesn't mean that that if you have it, you sell it. But if you had just bought it for this as an event, it's better to
So if someone wants to enter now, they should hold for a correction before they buy. Vivek, what's your sense? Do you agree or you have a different view?
Well, even whether a top has been made or not, one doesn't sell secular growth stories like Nestle for the simple reason that if one sells now, it's very difficult to re-enter any time in the near future, and that's my personal experience and experience of large number of investors in a stock like Nestle. So Nestle, for notwithstanding the valuation, is basically a story of increased penetration and premiumization in terms of within the FMCG basket. So basically, it's got a much superior product portfolio compared to, say, an HUL or some of the other FMCG names. Number one. Number two, it's a story of terrific track record in terms of financial management, of sustaining growth with very little capital employed. So this company, like the return on capital, return on equity has always been in excess of 70%, dividend payouts in excess of 70%, 75-80% dividend payouts. There have been periods when it has paid out dividends more than their earnings in that particular year, and all of that likely to sustain. An extension to your valuation, yes, the multiples may look expensive, but if we look at the dividend yield, it's just about 2.5-3%. Not just about, it is 2.5-3%, and compared to all other 49 Nifty stocks, 2.5% dividend yield for Nestle probably is the highest. So even if the stock were to correct, your 2.5-3% yield that you're going to get on the dividends pays for holding and waiting, even if the stock is in a range bound for a while. Stocks like this typically correct in terms of valuations for two reasons. The stock price may not collapse, but it may just be in a range bound horizontal chartically, if I were to talk about, while earnings catch up, and hence your maybe 48 times earnings may come to about 30 times earnings 2 years down the line. And that's how the correction in some of these stocks happens. And this is what I've observed over the last 20 years. So one does not necessarily sell or exit unless one has bought for a trading position. From an investment point of view, any decline, I think, is a buying opportunity for Nestle.
Okay, what's your sense, Hari, Nestle?
No, I would broadly agree with Vivek, that the question is, if you exit Nestle today, what do you buy? Let's assume that you're going to reallocate.
Should someone buy at this level? That's what the other thing.
There are two ways to look at it. I think one is, if you sell Nestle, what do you buy? Second is, should you buy? I think if you have a very short-term perspective, probably Nestle could disappoint. But then if you have let's say, a time frame of about 2-3 years from now, I don't think Nestle should really disappoint anyone. I'll come to the valuation part later. See, let's understand one thing, that about 6 years back, before the whole Maggie issue started, the stock was about 7,000. So it is roughly about doubled in 6 years. So that's about 11% annualized growth, which I think is not too much if you look at the kind of historical return baggage that the stock has. earnings growth in the last, I think, 8 to 9 quarters, the series is in a big growth in terms of the earnings growth plane. So that is, I think, something that's positive. Product portfolio, I think they are extremely strong in coffee as well as in noodles. I think two of the principal products. And most importantly, coming to the valuation part, is 60 expensive? I think look at DMart. DMart is at 100 and still it's going up. So I don't think we should give too much credence as far as the PE number is concerned. I think as long as Nestle can maintain the the higher growth and the niche market, unless there's another debacle like the Maggi zinc issue that we had about 5 years back,
lead.
I don't think there is any lead issue that you had. I don't think that we should have too much of a risk buying into Nestle at these prices.
Okay, that's the view that's coming in on Nestle. I think the consensus view is if you hold for a long term, yes, it's a stock that you would want to hold. I think as many people say, quality comes at a price. Probably that's what's playing out on Nestle. The next stock we want to talk about is another stock which is now at crossroads. What could happen? No one knows, and that is the entertainment. They have been on record and they've done a lot of things to reduce debt, but the debt is on the promoter level. Is Z worth an investment? Now at this price of 260, at the valuation you're getting in one of the largest media conglomerates in India. Whether they can stay, whether they will be taken over, no one knows. But at this point of time, 260. What's your sense, Vivek? Should someone has or wants to buy nothing? If someone wants to buy now, should they buy or no?
I don't think it merits a buy. Although the business, the core entertainment business is very strong, a very strong compounding machine, and a very strong network, at least in India and the Indian diaspora in the rest of the world. But the stock is now on a downward spiral, sort of in a vicious circle, given the promoters' other businesses, namely the infrastructure and the power business, for which they have leveraged by pledging their holdings in Z. So now the promoters have been trying to sell Z for the last more than a year. Differences in valuation expectations between potential buyers and for the promoters, the deal did not happen, and now the stock has been on a downward spiral, so it becomes even more difficult to do a deal. Of course, in between they placed 10% with Oppenheimer, and about 4,500 crores was repaid just about few weeks ago, but that's still not enough. Now they've taken time with the lenders, who are the mutual funds and few NBFCs, but I think at some point of time lenders will lose out patience and they'll not wait too long. So somebody just needs to press the panic button and offload large blocks in the market, and everybody else will do it. So now it's actually a stock in a race to the bottom, notwithstanding the terrific underlying entertainment business it is. So it's the promoter's problem which is hurting the company now. I think it's in a vicious circle, and I think one just needs to stay away.
Sharmila, would you agree, or you have a different
So I was just reading a story on Bloomberg, in fact, which said that the 4 people who are sort of who continue to hold into Z, so they've named 4 mutual funds. But if you add up what they're holding in Z is the pledge shares, it doesn't sort of add up to the entire debt that Z has outstanding at this point in time. So which leads me to the question that who are the other names, and if they haven't entered into this agreement with Z, that means what happens to their shares? So will they be offloading those shares in the market as time goes by? Then also I think there's this story again, I think it was on Bloomberg, which said that that SEBI has actually come out and said that we don't know how they're doing this, because there is nothing to, you can't come to a standstill agreement with lenders. So I really don't understand that how even these 4 names can agree to come to a standstill agreement if SEBI is saying you can't do a standstill agreement. And they were already given time till September. And I mean, the fact remains that, once you know that this guy is in trouble, nobody is willing to give him that price. Everybody will try to do that hard bargain. So I think they're in a sort of a really, really tight spot. And
so it's an avoid.
So I think until you see this repayment thing coming in, I would completely avoid it.
So I think one thing is for sure, to stay informed, you read Bloomberg and BloombergQuint.
Absolutely.
Hari, what's your sense on Z?
No, clearly I think it's an avoid. I would agree with both of them. I'll come to that the pledge shares issue later. Even if you look at the core business, I think there was a lot of bets on Dish TV, the digitization, and the spread of the Z TV. I think nothing has worked. And Dish TV, in fact, despite some of the largest broking houses pushing Dish TV, it has been one of the most disappointing stocks in the last 15 years. So I think to that extent, the digital game, they will definitely lost out. I think as far as the broadcasting is concerned, my concern is that it is changing very, very rapidly and it's going to change more rapidly in the next 5 years. So, you have those Jios and Bhartis coming with your mobile televisions, and I think very soon we'll be having a situation where a large part of the TV population is going to shift, and that's already started. So I think that the core business itself is going to be under pressure. Now coming to that part, I think the promoters ended up looking very, very bad when they postponed the standstill by another 6 months. Had they stuck to the 6 months, I still think that market should have taken them a little more kindly. But when they actually took this commitment so lightly, that has not gone down well. And my understanding is whether the mutual funds talk about it, they don't talk about it, there is a steady amount of selling that's already started. And we are going to see that continue till the time most of the mutual funds get out of the stock completely. So, I've been, I think, negative on the stock since around 450, 500. Even at 260, we are negative. I think our target is much below 200 for the stock.
Okay, that's the view. So it's a complete avoid on Z Entertainment till the time there is clarity. We just have time to skip to the last stock, and that is MCX. Now, there are 3 major exchanges in India. You have NSE, which is trying to get listed, but it's not getting the permission. On the other hand, you have BSE, which is trading at record lows. Nothing seems to be working for them. And the other end of the spectrum is MCX, which is trading at record highs. Doesn't do much of equity, but yes, it's the commodity play, and the divergence is very sharp in the last 6 months. BSE is down 7%. MCX is up 20%. Hari, your sense on MCX? Is it worth investing?
I'm a little wary of the whole group. I know that the original promoters have gone out, but then we find that the entire promoter group that was originally founded this company appears to be a little too shady to give us comfort. Number 2, I think what is more important is that the exchange business, as we realized in BSE, and BSE has a lot more of franchises and assets compared to MCX. Despite that, the BSE has been struggling to get a better valuation in the market. And let's say once BSE and NSE are able to kick off their commodity business in a much bigger way, I think MCX is going to really, really feel the pain. And let's not forget that when it comes to institutional commodities, once it starts, BSE and NSE have a much bigger advantage compared to MCX. So as far as we are concerned, I think MCX is a stock you should strictly avoid. From the time I think the commodity transaction tax has been introduced, we have been saying that we are negative on the stock overall.
Okay, negative on the stock. What's your sense, Sharmila, MCX?
No, I'm positive on the stock, and I think simply because I think that they have a good market share in the commodity business, and I don't really see them losing that in a hurry, because I don't think that people really just shift to another exchange for lower cost or whatever. And secondly, I think the outlook on commodities as a business, I think, is pretty exponential, going ahead. I think we are in a very, very nascent stage as far as the commodity market goes. I think even in terms of derivatives trading, we are at a very nascent stage in the equity market, but I think in commodities even more so. So I think there's lots more that can happen in that space, and this market can expand. So I would stay positive on MCX.
Okay, so one positive view, one negative view. Vivek does not track it, so he will reserve his comments. But with that, we've completely timed out on this edition of Hot Money. We discussed a lot of stocks, a lot of details came out. But let me thank my guests who've come in today, Vivek, Sharmila and Harihar. Thank you so much for coming in today. Our Speak You comes up next. Stay tuned to BloombergQuint.